Welcome to the deep dive. We received a trading strategy aimed at newer traders, sent in by a listener.
Okay.
We're calling it Mansi's trading strategy for novice traders, and today we're just going to unpack it.
Exactly. See how it works, what the core mechanics are. Just focus on this specific strategy.
All right, so let's jump into the entry rules. First thing, the Daily Relative Strength Index, the RSI,
Hmm?
that needs to be greater than 60,
Okay.
but also it has to be less than 63. So a really tight window there.
That is tight. 60 to 63. It often suggests something that's like just starting to move up, but isn't totally overbought yet.
Right, not extreme, kind of catching it early.
Potentially, yeah. Trying to pinpoint that specific kind of momentum that's building but hasn't, gone vertical.
Got it. Okay, there's another piece to the entry.
Oh, yeah.
In the week before this potential entry, the daily RSI had to have been below 60.
Ah, okay. So it's not just hitting that 60-63 range out of the blue.
Exactly. It needs to come from below 60 recently.
That adds a bit more context, doesn't it?
Yeah.
Suggests a clearer shift from maybe consolidation or lower momentum into that potential breakout zone. It's looking for a change.
Yeah, a definite buildup. What about relying just on RSI like this, though? Especially that tight range. Any downsides pop into your head?
Well, sure. I mean, what if a stock really takes off?
Right.
It might just blow straight past 63 before you even get a signal.
Yeah.
Based on these rules, you could miss the initial big jump sometimes.
True. It's selective, maybe too selective sometimes. A trade-off.
It's always a trade-off. Precision versus catching every move. Okay, so that's getting in. What if the trade starts to go wrong? How do you get out?
Stop loss. It's pretty clear on this one. If the daily RSI goes back below 60 after you're in the trade,
You exit. Simple as that.
yeah, cut the loss.
Okay, so that's the safety net. A clear RSI-based trigger if the momentum fades. Got it.
Right.
So we have entry, we have the stop loss. How does the strategy plan to take profits?
Okay, the profitable exit. It's got two conditions, and crucially, they have to happen on the same day.
All right, condition one.
First, the RSI has to cross above 75.
Okay, the classic overbought territory signal suggests the buying might be getting exhausted.
Right, but that's not enough on its own for this strategy.
There's more.
Yes. On that same day that the RSI crosses 75, the stock's price needs to close below the low of the previous day.
Ah, that's interesting. So high RSI suggesting strong momentum, but the price action on the day is actually weak, closing below the prior day's low.
Exactly. It's like the momentum is high, but the conviction might be faltering right at the peak.
Yeah, that combination is key. It's looking for that divergence, high RSI, bearish price close. A potential signal that the short-term top might be in. Could this maybe get you out too early sometimes?
I suppose if it's just a one-day dip, maybe a brief pullback on a strong day that then continues higher the next day.
Could happen. This strategy seems to prioritize locking in the gain. When you see that specific combination overbought RSI plus that negative price action, better safe than sorry, perhaps.
Okay, so let's just quickly recap that for you, the listener.
Good idea.
Entry. Daily RSI moves into the 60 to 63 zone, but it had to be below 60 in the week prior.
Check.
Stop loss. If the daily RSI drops back below 60 after you enter,
Got it.
and taking profit. Happens if, on the same day, the RSI goes above 75 and the price closes below the previous day's low.
Both conditions together.
Both together. And just to be clear, we're just exploring the mechanics of this specific strategy as it was shared with us.
Exactly. Understanding the logic within these particular rules.
All right, let's wrap up this deep dive. Mansi's strategy uses these very specific RSI levels, below 60 as a sort of baseline or stop loss trigger.
Then that tight 60 to 63 band for entry, signaling maybe early momentum.
And then above 75, combined with price action, signaling it might be time to exit. So fundamentally, it seems designed to identify that initial upward thrust, manage the downside risk with that RSI stop, and then try to capture gains when signs point to the momentum possibly reversing.
A structured approach using just the RSI and some basic price action.
Which leads to a final thought for you to consider. How might these different RSI zones below 60, that 60-63 entry window, and then above 75, how might they reflect different phases of momentum or potential turning points? And what else could exploring the RSI indicator, beyond just these rules, tell you about its application in trading, something to maybe dig into further? Thanks for joining us.